Preparing for FP&A Analyst at PKP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A do, and how would you add value at PKP? FP&A is the planning and analysis function that connects operating performance with management decisions. At PKP, I would translate passenger or freight volumes, fares, energy costs, payroll, maintenance, and capital spending into budgets and forecasts. I would compare actuals with plan, explain variances, and update the outlook using operational drivers rather than simply extrapolating history. The output should help leaders allocate cash, protect service quality, and achieve strategic targets. While answering, focus on FP&A's role in planning, forecasting, performance analysis, decision support, and business partnering, connecting financial results with railway operating drivers such as volumes, fares, energy, payroll, maintenance, and capital expenditure. Question 2. How would you build an annual budget for a railway business? I would begin with strategic targets and a clear timetable, then build the budget from operational drivers. For PKP, those could include train kilometers, passenger volumes, freight tonnage, pricing, staffing levels, electricity consumption, maintenance schedules, and planned projects. I would collect assumptions from business owners, challenge them against historical performance and external factors, and model operating expenses, revenue, cash flow, and CapEx. After management review, I would document approvals and establish monthly tracking. Make sure to cover the budgeting timetable, assumptions, driver-based modeling, departmental ownership, operating and capital budgets, review iterations, scenario analysis, approvals, and controls over version management and assumption consistency. Question 3. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial commitment for a defined period, usually the next fiscal year. A forecast is management's latest estimate of what will actually happen and should be refreshed as conditions change. A long-range plan looks several years ahead and links financial outcomes to strategy, investments, financing, and capacity. At PKP, the budget could control annual costs, while the forecast reflects changing traffic or energy prices and the long-range plan supports infrastructure decisions. In your answer, distinguish the fixed annual commitment from the rolling estimate and strategic multi-year view, explaining their different purposes, time horizons, update frequencies, assumptions, and uses in management decision-making. Question 4. How would you prepare a monthly management reporting pack? I would start by validating the general ledger, operational data, and reporting hierarchy, then prepare actual versus budget, prior year, and forecast comparisons. The pack should highlight revenue, costs, EBITDA or operating result, cash, CapEx, service KPIs, and material risks. I would write concise explanations linking variances to drivers such as volume, price, timing, or efficiency. Finally, I would show the forecast impact and recommended actions, not just present historical numbers. Be sure to mention data validation, concise KPI presentation, actual versus budget and prior year comparisons, variance commentary, operational drivers, forecast implications, visual clarity, deadlines, and tailoring content to management decisions. Question 5. How do you perform variance analysis? I first identify the material variance, then separate it into understandable drivers. A revenue shortfall might reflect lower passenger volume, weaker pricing, or an unfavorable route mix. An energy variance could result from consumption, tariff rates, or timing. I would reconcile the analysis to accounting records, discuss operational causes with budget owners, and quantify whether the issue is temporary or structural. The final commentary should explain both the current variance and its forecast consequence. Focus on decomposing variances into volume, price, mix, timing, rate, foreign exchange, productivity, and one-off effects, validating explanations with stakeholders, quantifying forecast impact, and distinguishing controllable from uncontrollable items. Question 6. What would you do if a department consistently exceeds its budget? I would not assume poor discipline immediately. I would examine the recurring overspend by account, timing, vendor, and operational driver, then compare the original assumptions with actual activity. I would meet the department owner to determine whether costs reflect higher service demand, inflation, emergencies, or weak controls. Together, we would revise the forecast, identify actions such as procurement savings or scheduling changes, and escalate unresolved structural overruns with quantified impacts. Mention fact-finding before judgment, trend analysis, separating legitimate operational changes from weak control, validating forecasts, engaging the owner, agreeing corrective actions, escalating material risks, and monitoring accountability through follow-up reporting. Question 7. How would you forecast revenue for PKP? I would use a driver-based model rather than applying a blanket growth rate. Passenger revenue could be forecast from journeys, average fare, route mix, and seasonality. Freight revenue might use tonnage, yield, customer mix, and contract terms. I would incorporate service capacity, planned pricing changes, economic conditions, and known commercial initiatives. I would test base, upside, and downside cases, then reconcile the forecast monthly to actual volumes and pricing. Talk about passenger or freight volumes, pricing, route or customer mix, seasonality, service capacity, historical trends, commercial initiatives, macroeconomic factors, scenario ranges, and reconciliation to actual booking or operating data. Question 8. How would you forecast operating expenses in a railway company? I would classify costs by behavior and forecast each major category using relevant drivers. Payroll would reflect headcount, vacancies, pay increases, overtime, and workforce plans. Energy would incorporate consumption, tariffs, and hedging where relevant. Maintenance would follow asset schedules, contract terms, and reliability requirements, while other costs would reflect inflation and procurement assumptions. I would identify one-offs separately, challenge unsupported growth, and provide sensitivities for energy, wages, and activity levels. Cover fixed and variable cost behavior, headcount and wage assumptions, energy and fuel prices, maintenance cycles, supplier inflation, contracts, one-off costs, productivity measures, and sensitivity analysis for major drivers. Question 9. What KPIs would you monitor in FP&A for PKP? I would combine financial outcomes with operating indicators because railway performance cannot be understood from accounting data alone. Key measures could include revenue, operating margin, cash flow, CapEx delivery, passenger journeys, freight tonnage, yield, train kilometers, cost per train kilometer, punctuality, asset utilization, and safety metrics. I would monitor trends in relationships, such as whether higher service levels are producing profitable volume growth, and ensure every KPI has a clear owner in action. Include financial and operational measures such as revenue, operating margin, cash, CapEx, passenger or freight volumes, yield, punctuality, train kilometers, cost per kilometer, utilization, and safety or service indicators. Question 10. Explain how the three financial statements connect in FP&A. The income statement shows profitability, the balance sheet shows financial position, and the cash flow statement explains movement in cash. Net income affects retained earnings. Depreciation reduces profit without using cash. CapEx increases assets and reduces cash, and working capital movements also affect cash. In an FP&A model, operational assumptions should flow through all three statements. That integration helps PKP assess whether growth or infrastructure investment is affordable, not merely profitable. Explain the income statement, balance sheet, and cash flow statement linkages, including profit, working capital, depreciation, CapEx, debt, cash, retained earnings, and how forecast assumptions flow through an integrated model. Question 11. How would you analyze working capital? I would analyze receivables, payables, inventory, and accruals against revenue, costs, historical trends, and operational activity. For PKP, I would examine collection timing from customers or counterparties, supplier payment terms, maintenance inventory levels, and large project accruals. I would separate timing effects from permanent changes and quantify cash impact through days or turnover metrics. Actions might include faster invoicing, disciplined collections, inventory optimization, and better purchase order and accrual controls. Mention receivables, payables, inventory, accruals, cash conversion, payment terms, collection behavior, seasonality, operational causes, supplier relationships, and practical actions that improve liquidity without disrupting service. Question 12. How would you evaluate a proposed capital investment in rail assets or infrastructure? I would start with the strategic and operational case, then quantify incremental cash flows rather than relying on accounting profit alone. I would include construction costs, timing, maintenance, energy savings, capacity benefits, revenue, residual value, and any working capital effects. I would calculate NPV and IRR, test delays, cost overruns, utilization, and demand assumptions, and compare alternatives. After approval, I would track benefits, spend, milestones, and actual returns against the original case. Cover strategic rationale, initial investment, operating benefits, useful life, maintenance, depreciation, incremental cash flows, NPV, IRR, payback, risks, funding, sensitivities, alternatives, and post-investment performance tracking. Question 13. What is a rolling forecast, and how would you implement one? A rolling forecast continuously extends the planning horizon, for example maintaining the next 12 or 18 months after each reporting cycle. I would refresh key drivers monthly or quarterly, replace outdated assumptions with actual results, and keep the model focused on material variables. At PKP, that could mean updating traffic, pricing, energy, staffing, maintenance, and CapEx timing. I would assign owners, automate reliable data feeds, and use the forecast to identify actions early. Explain continuous updating, a consistent forward horizon, driver-based assumptions, monthly or quarterly refreshes, removal of obsolete periods, ownership, automation, and using forecasts for decisions rather than performance punishment. Question 14. How would you build a scenario analysis for changing energy prices? I would establish a baseline using expected train kilometers, electricity or fuel consumption, contracted prices, and hedge coverage. Then I would model alternative price and activity assumptions, separating market exposure from consumption efficiency. For example, a higher energy price case should show impacts on operating costs, margin, cash flow, and possibly fares or service decisions. I would present a practical range, explain timing and confidence, and identify mitigations such as procurement, scheduling, or efficiency initiatives. Mention baseline consumption, tariff assumptions, hedging or contracts, volume sensitivity, operational offsets, upside and downside cases, probability or range framing, cash and profit impacts, and management actions. Question 15. How do you ensure data accuracy in Excel or an FP&A system? I use a controlled process rather than trusting a model because it looks correct. I reconcile source data to the general ledger or operational system, standardize definitions, separate inputs from calculations, and use checks for missing data, unexpected movements, and balance consistency. I maintain version control, protect formulas, document assumptions, and obtain an independent review before distribution. For recurring reporting, I would automate stable steps while retaining clear audit trails and exception-based review. Focus on source reconciliation, standardized definitions, controlled inputs, formula checks, cross-footing, version control, audit trails, access rights, independent review, exception reporting, and documenting assumptions and changes. Question 16. Which Excel skills are most important for an FP&A analyst? I rely on Excel to structure data, analyze drivers, and communicate conclusions. Important tools include SumIfs, XLOOKUP, index match, pivot tables, charts, scenario analysis, and Power Query for repeatable data preparation. I also build clear input, calculation, and output sections with error checks and documented assumptions. I use formulas that others can audit, avoid unnecessary complexity, and automate repetitive work where appropriate. The objective is a reliable decision tool, not an impressive spreadsheet. Mention some ifs, XLOOKUP or index match, pivots, dynamic formulas, scenario tools, charts, Power Query, error checks, data organization, model readability, and knowing when automation improves control and efficiency. Question 17. Tell me about a time you improved a reporting or forecasting process. In a previous role, monthly reporting required several manual downloads and took nearly 4 days. I mapped the process, standardized account and department mappings, and used Power Query to combine recurring source files. I added reconciliation checks and a dashboard showing material variances. The process fell to roughly 1 day, errors decreased, and the team spent more time discussing drivers with managers. I would apply the same improvement mindset to PKP's recurring planning and reporting cycles. Use a concise STAR structure, quantify the starting problem, explain your analysis and stakeholder coordination, describe the process improvement, and show measurable benefits in time, accuracy, insight, or control. Question 18. How would you handle conflicting priorities and tight reporting deadlines? I would clarify deadlines, decision needs, dependencies, and materiality before starting. I would prioritize outputs that affect management decisions, create a short work plan, and communicate early if a dependency threatens delivery. I would complete core reconciliations and quality checks before adding lower value detail. If necessary, I would deliver a clearly labeled preliminary view and follow with refinements. Remaining calm, documenting assumptions, and escalating risks early are more effective than silently missing a deadline. Discuss materiality-based prioritization, deadline planning, stakeholder communication, dependencies, quality checks, escalation, maintaining controls, and delivering a useful first version without sacrificing accuracy or transparency. Question 19. How would you explain a poor forecast to a non-finance manager? I would avoid finance jargon and explain the result through operational facts. For example, I might say that the forecast declined because passenger volumes were 8% below plan and energy costs were higher, with each factor's quantified impact. I would distinguish external effects from controllable actions, such as timetable changes, pricing, staffing, or procurement. I would confirm the manager agrees with the diagnosis, then jointly define actions, owners, and timing for improvement. Emphasize plain language, operational drivers, evidence, no-blame communication, quantified impact, distinction between controllable and external factors, recommended actions, and confirming the manager's understanding and ownership. Question 20. Why do you want to join PKP as an FP&A analyst? I am attracted to PKP because rail combines financial complexity with a visible economic and social impact. The business requires disciplined decisions around service levels, infrastructure, assets, people, energy, and long-term investment. FP&A would let me connect operating data with those choices and work closely with finance and operational teams. I would bring strong analytical discipline, curiosity, and clear communication, while developing deeper expertise in a large, asset-intensive transport organization. Connect your motivation to PKP's scale, transport and infrastructure importance, analytical complexity, public or customer impact, cross-functional exposure, and your ability to turn data into disciplined financial and operational decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.